In an era where technology races forward faster than governments, markets, or even societies can adapt, a new and far more volatile battlefield has emerged, one where the stakes are not measured in territory or weapons, but in silicon, data, energy, and the sheer velocity of innovation. And this battlefield is the accelerating AI war that is now beginning to strain the U.S. economy like never before, pushing it into a pressure chamber where every assumption about growth, capital, and national security is being tested all at once. There's simply no way to wage this war and go pedal to the metal forever without encountering severe structural limits, because the reality is brutally simple. Building endless fields of hyperscale data centers filled with Nvidia chips is an impossible situation in a country like the United States. The U.S. is not a low-cost manufacturing destination. It is the exact opposite. And because of tariffs layered across the supply chain, now everything from copper wiring to steel frames costs 20 to 30% more, inflating every component of construction and forcing an astronomical amount of capital just to build this so-called field of dreams. Eventually, even Wall Street, usually fearless in the face of risky innovation, is now terrified. This AI bubble expanding on borrowed money and speculative optimism could take down the entire U.S. economy because it all ties back to the money supply and the terrifying possibility of credit suddenly freezing up. According to JPM, the biggest concern is a flood of data center financing that could cause supply indigestion, particularly in dollars, because big tech companies are issuing too many bonds at once. 2025's issuance is nearly $240 billion, a number so extreme it's double last year, and even higher than the spending boom after the pandemic when rebuilding was urgent. Here's the real issue. By 2028, tech firms are expected to borrow over $1.5 trillion, and that's just for AI alone, purely for capex related to data center expansion. This creates a kind of two-body problem. One body, big tech, sucking up the world's capital, inflating an unstable bubble. The other body, real industries starving of credit, contracting simultaneously. So the manufacturing base shrinks while tech spending explodes. And because these two forces interact, nobody knows which sector will pull the economy down first. If Main Street loses jobs, how will big tech secure revenue to pay back mountains of debt? Worse still are the results of using AI inside the U.S. MIT studied generative AI usage in corporate projects. Plenty of companies explored AI, only a small fraction tested pilots, and the success rate was shocking. Only 5% saw any return. The other 95% was wasted effort or outright failure. This raises serious questions about whether these massive AI investments are sustainable. No one denies AI will revolutionize everything. It will be bigger than the internet. But the problem is the hype being pushed aggressively by Jensen Huang. He says we're just at the beginning, claims most people don't use AI yet, insists someday AI will be part of everything we do, every moment of the day, and that between today's low usage and tomorrow's constant usage lies a massive build-out. But here's the issue. Investors on Wall Street crave returns. When AI investments don't return profits, they know exactly what it means. Less business for hyperscalers, more risk for borrowers, cascading defaults on bonds, and suddenly creditors get wiped out. This isn't fear-mongering, it's how credit markets function. Just look at traders and what they're doing to Oracle. The company is taking on tens of billions in debt for their AI expansion, and the market is betting against them. A massive $4.2 billion worth of bets have entered Oracle's credit default swaps, meaning traders are betting Oracle will default and they're positioning to profit from a crash. If AI revenues were guaranteed, these bets wouldn't exist. Meanwhile, experts say credit spreads will widen above 100 basis points from 75 this year, meaning U.S. companies will pay much more to borrow money compared to the Treasury. The U.S. government already competes for capital flows, and now tech bros enter the same race. How much can Main Street borrow under these conditions? It will cost a fortune. And if 2025 looks rough, 2026 may be catastrophic. That's when things might truly hit the fan, as fallout could freeze U.S. credit markets entirely. A disaster for an economy already running on endless deficit spending. In 2026, just 4 of the Magnificent 7 tech giants will spend over $400 billion on AI, most of it financed by debt. That's why Trump is desperate to lower interest rates. The push to pressure the Fed into cutting rates is directly tied to keeping the AI bubble alive, allowing companies to borrow cheaply to build more data centers. But building the structures isn't enough. There's the power grid to consider, and more surprisingly, whether enough water exists to cool these data centers. People often forget the basics. Many U.S. data centers are built in remote areas, partly to avoid taxes and stay close to energy sources. But this creates another problem in places like Texas. Where's the water? Data centers require vast amounts of water to cool operations. 2/3 of data centers are in regions with water stress, possibly over 70%. It's as absurd as TSMC building a chip plant in the Arizona desert. You might as well build it on the moon. That's why data center costs will keep escalating. It's not just chips and construction. It's all the ancillary infrastructure: water, power, land, cooling, and substation upgrades. Another point: hyperscalers have AA or AAA credit ratings, letting them borrow cheap capital. Main Street does not. When credit supply drops, the price of money, interest rates, rises. We could see a repeat of 2008 when credit markets froze. Treasury borrowed at 2.4%, while BBB-rated companies paid over 10%, 4 times higher. Now both Bezos and Silicon Valley are borrowing aggressively again. The ending could be ugly. Trump knows things are approaching a breaking point. Washington is scrambling for money, and Trump wants it from China. After years of claiming China's economy is collapsing, now the U.S. suddenly needs Chinese capital. According to Lutnick, Trump is considering selling advanced Nvidia H200 chips to China, the more powerful successor to previous export-approved variants. National security concerns are being sidelined in favor of economic survival. Translation: the U.S. needs Chinese money to keep the AI bubble alive, or the entire market risks collapsing. After a call between Trump and China, Trump even agreed to visit China. The U.S., after tariffing Chinese companies aggressively, is now running back for trade cooperation. This is an upside-down world. Trump will likely push China to lift its ban on U.S. chips, a matter as critical as rare earth minerals, which remain unresolved. Lutnick finally realized the U.S. is trapped in a double bind. If the U.S. doesn't sell chips, China will innovate faster and develop more powerful Huawei Ascend chips. But if the U.S. does sell chips, China will stockpile H200s while continuing to accelerate domestic development. Progress can slow but never stop. Trump appears to be choosing the latter because the AI bubble is out of control and Chinese revenue is indispensable. U.S. spending on AI now exceeds half of all investment nationally, meaning the entire U.S. economy is betting on AI's victory. Success depends on 2 things: uninterrupted rare earth supplies and stable corporate revenue. Without both, CapEx overcommitment becomes dangerous. The U.S. is backed into a corner, which is why Washington is surprisingly cooperative with Beijing lately. Behind the handshakes and smiles lies pure leverage politics. Nvidia stock immediately jumped 2.5% on news of warming U.S.-China relations. But China has banned U.S. chips from state-sponsored data centers, a huge barrier. Beijing might not reverse that ban, but they will likely allow massive stockpiling of H200 chips because the performance gap is too large to ignore, and sanctions might flip again any moment. By selling H200s, the U.S. removes China's short-term bottleneck, but also dilutes its own technological edge. The H200 is 8 times more powerful than the H20, with far higher processing power and memory bandwidth. Trump gets revenue and maybe slows China slightly, but he also helps China leap forward in AI. If DeepSeek was created using weaker U.S. chips, imagine what China could do with H200s. The fourth most powerful AI model today is already Chinese, Kimi K2, built without top-tier chips. That's like Tony Stark building Iron Man in a cave. Imagine what happens when they get H200s. They might as well build a time machine. Selling chips to China won't magically save the AI bubble. Instead, China could build even stronger models that compete globally, pushing prices down and squeezing U.S. revenues. Things are far more complex than Trump or Lutnick believe. So what do you think? Will the AI credit bubble improve or collapse? And will China really buy U.S. chips? Leave your thoughts in the comments below. Stay safe, and don't forget to hit like and subscribe as we navigate these chaotic times.